Yo, what's up, guys? It's JJ. Back with some content. It's been a while since I've hopped on the call and sort of put out some content, but yeah, I'm going to be putting together sort of a boot camp call, just sort of going through every aspect of my trading, every topic, and sort of every area and detail that I use, and then eventually sort of putting it all together to come to sort of the strat that I'm using at the moment. My entry criteria and my sort of checklist, which I need to see before I enter a trade pretty much every day of the week. So, and yeah, obviously at the end, we'll go through lots and lots of case studies, but yeah, we're just going to be sort of breaking it down by topic. I have no idea how long this recording is going to be. Could be like 3-4 hours. I have no idea. It depends how long it's going to take me to sort of go through and record all of this and explain it across. I want to make it as informative as possible and use a lot of live chart examples too, just so you can sort of hear me rambling on, explaining things and showing you good examples of stuff. But yeah, I'll give you a quick breakdown on sort of how the call is going to go. So to start with, we're going to sort of give an introduction to algorithmic theory, and where this thought process can essentially be derived from, and some details about it. And then obviously throughout the call, we'll be able to dive deeper into the algo and explain more of the theory as we're actually showing stuff. It will just make more sense. And then in terms of technicals, obviously we're going to be focusing a lot on liquidity, the actual sort of cycles, the liquidity trading that we use, obeys upon all types of trappings, a lot to do with sessions, so session liquidity, and most importantly, the characteristics of sessions and ranges and timings, stuff like that. Trap timings, we're going to have, all the necessary cycles, so low time frame, high time frame, liquidity cycle, and then cycles for our bias for future price action, so daily cycle and weekly cycle. We're going to be talking about a lot about structure, but not necessarily the structure you may use, but more so looking at structure in terms of liquidity, also known as algo structure, which is a big part of our trading. Things like that, a lot to do with volume, money transfer, sort of choosing the right areas, knowing which levels are the correct sort of key draws on liquidity, sort of early liquidity trappings, so fake breaks of structure, fake changes of character, smart money traps, all types of different models. And also we're going to sort of touch on some little details about specific types of algos which operate in the market. So for example, time weighted average pricing algorithms, volume weighted average pricing algorithms, things like event-driven algorithms, smart order routing algorithms. There's plenty which we can sort of touch on here and there just to sort of give a good insight. And then, yeah, as I said, quite a lot of case studies towards the end. So it's going to be quite a hefty, quite a chunky session, but, we're going to get through it. We're going to smash through everything. Thank you for purchasing this recording. I've put a lot of time into it. I sort of advertised it on my story and thought, if there's enough interest, then I'll put something together. There was quite a lot of interest, so I thought, it's going to be worth me sort of putting something quite detailed together. I wouldn't, I can't just do things lightly. If I do something, I take it serious. So I'm going to be putting a lot of effort in, putting a lot of time in. I've planned this call and stuff, so yeah, it's going to be a blast. So let's get ready. So let's make a beginning, and we're going to start talking about sort of the context behind algorithmic theory, where we can sort of derive some of these concepts from. So to begin with, the most sort of important thing to know about the market is it can be described as a zero-sum game, which means essentially for every buy transaction, there's an equal corresponding sell transaction, which is sort of matched upon each other. And of course, vice versa. So you can look at the market as there's always an equal amount of buys compared to sells. However, the thing that changes in the market is sort of the formatting of the data. So at certain areas and price points in the market and at certain times, there may be a certain amount of buy orders at this particular level compared to sell orders. And that's where we can sort of derive our strong liquidity points, where we have that sort of large imbalance of buys compared to sells at a particular price point. So the thing to know about the algo, well, essentially the algorithm is AI based, run by a supercomputer, uses very complex mathematics to operate. And this, the algo will essentially use data to run. It doesn't know what a chart looks like. So the algorithm doesn't sit there and see highs and lows. It doesn't see support and resistance. It doesn't see supply and demand zones. The algorithm just knows data, and what data is liquidity, which is a magnitude or a particular amount of orders at a certain level, at a certain price point. So the algorithm just knows that at this level here, we have this much money resting here, and at another level here, we have this much money resting here. So it doesn't see an equal high or support and resistance or supply and demand. It just knows that there's an imbalance and a formatting of data. So like, okay, at a particular level, we have a high amount of liquidity or a high amount of transactions resting there. And then we may have slightly less, and then we have a larger amount. So obviously the differ between a large amount of liquidity in the market and a lower amount is what we'd refer to as an imbalance. And the large blocks of data is our sort of key liquidity points we're going to be sort of talking about. So the algorithm is essentially attracted to these data points. And like I said, using mathematics, it can calculate the most cost efficient way to inject and produce market movement to attack these data levels and like liquidity levels, in which it can in result harvest the liquidity, which is quite a good analogy. So come to a level and harvest liquidity, take it, and then from there move to its next desired location, and making a profit sort of as a result of that movement. So another thing to know about the market is that if liquidity exists, then manipulation is always going to exist. And you need to sort of look at the market in terms of numbers and orders of magnitude. The chart is just a graphical way to represent data and the actual layout of data formatting in the market. So the algorithm doesn't know the chart. It's just we can see the chart and use the chart to our advantage. It's just a graphical way to display transactions and data on a database, which an algorithm is using, and applying mathematics to calculate its movements. Of course, the way the algorithm runs essentially is that it requires a large amount of capital to inject and move the market. So it's essentially hedging large funds and large private equity and large capital injections to actually move the market to its desired sort of levels. The most fundamental thing to know about the market is the market always focuses on taking liquidity and building future liquidity, and these two cycles will occur in harmony with each other. So always pay attention to how the market will take liquidity, but prior to taking liquidity, it will induce more liquidity, and then after taking liquidity, it will induce future liquidity and build future liquidity. So once we've took a liquidity point, this area may have then become a liquidity point in a future price cycle. So depending on the time frame, the perspective. So a 15M drawn liquidity could become a 15M liquidity target in future for the next sort of 15M liquidity cycle. So once we have our next drawn liquidity, this area could become a target. So once a certain liquidity drawn has happened, price will be like, okay, right, now it's time to come grab this high again and continue the sort of order flow of the market to attend higher time frame directions and key levels, which is sort of trying to target. The market's fractal, of course, so everything. A good way to look at it is it's like an onion. So as you peel away a layer, there's another layer inside, and you can keep going all the way to the smallest layer right at the core. Hopefully that's a good analogy to sort of recognize how the market's fractal. So say, the 1M liquidity cycle evolves around the 15M liquidity cycle, which evolves around the 1 hour, the 4 hour to the daily, and then all of that plays a part in sort of monthly liquidity cycle. So, a big way the market will create liquidity is by inducement. So, by definition, what is inducement? Well, in our market, inducement focuses quite a lot on emotions. As an AI or a computer-based program or algorithm, it doesn't have emotion, of course. It can operate without emotion. So it's going to take advantage of human emotion, as that's the one thing it has an advantage over. So as well as human error, it has an advantage over that because it's an algorithm, of course. So the market will play very smart psychological games to induce liquidity, which is, essentially getting people involved or getting people in early or at the wrong time, taking advantage of emotional and uneducated traders or inexperienced traders, sort of generate more liquidity, which will act as sort of propellant for future sort of injections and liquidity runs, essentially. The market likes to have a balanced sort of equilibrium condition, because balanced market conditions allow both buyers and sellers to be sort of satisfied with placing orders. So when the market has repriced at a fair level, both buyers and sellers are sort of equal. A certain person buying a stock or a security at a certain price, there's also people on the other side of the transaction who are willing to sell it at that same price. So a fair exchange can occur. This is when the market will typically have the largest amount of liquidity. Essentially, it can be known as accumulating orders. And then post an accumulation, the market is likely to then manipulate these orders. So once a sufficient amount of liquidity is generated on both sides of the market, and the important part is the market does like to induce liquidity on both sides at the same time, and then essentially take liquidity from one side of the market. So essentially push the market up and take out sell side liquidity. And then after a sufficient amount of liquidity has been taken, then reverse to come take out the other side of the liquidity. So the market focuses quite a lot on build up on liquidity on each side of the market. One side gets taken, and then you can trade that to the next side of the market. But essentially, as price takes one level of liquidity, market conditions start to sort of become slightly imbalanced. Price is not at optimal pricing for both buyers and sellers to be satisfied with sort of getting involved with transactions. So if the market pushes up to a certain price, this could reduce market liquidity because people are in fear of taking sells because of how aggressive the market's moved up. But then at the same time, people could be buying because they're trying to catch the big pump up. So it's all a big sort of mind game. It's all a big cycle. So one of the most important things we're going to learn sort of throughout this call is how to spot the correct liquidity points, the correct sort of draws on liquidity, as well as types of algorithms which take place in the market. So for example, as I mentioned earlier, so time weighted average pricing, so sort of how the algorithm will divide its injected capital based upon time, and how this then takes part in our key timings and the daily cycle as well as the weekly cycle. And then 2, we have like volume weighted average pricing, which is how the algorithm will distribute certain amounts of liquidity in different volumes. So a large volume here, small volume here, a mid volume, sort of trying to accumulate, and then expand, manipulate orders, reaccumulate, take out more liquidity, sort of, paying attention to the whole cycle. More we're going to learn about is types of spoofing algorithms. So how sort of fake demand and fake demand and supply, and how a fake bias can be created in the market. And another type we're going to learn about is event-driven algorithms. So how certain algorithms are programmed to sort of manipulate news events. There's a model we have around news events. Obviously, we're not trading news because that is risky with slippage and stuff. It's just completely gambling to do that. However, post news events, the market always moves in a similar direction. News highs and lows, always very strong liquidity points, and the way the market sort of plays post news events are quite interesting. So that's like another sort of little detail we'll just touch on for a small amount of this call. So yeah, that's been quite a nice introduction to the algorithm. We're going to start off taking a look at sessions. I want to make sure I cover everything from start to finish in this call. Don't want to miss out sort of any details. I'm just going to cover things properly, and we have to go through the boring stuff, but we also have to go through the good stuff, the techie pieces of information, because we want to have a whole market perspective at the end of this call, which will then sort of put things into place when I come to covering my strategy at the end, my sort of checklist, what I'm working with at the moment, what I've got plenty of back-tested and live data on at this current point, and it's simply just how I view the market and how I trade it on a day-to-day basis. So yeah, it's going to be a good call, I can tell you that. And yeah, let's get straight into sessions.